It was another bad week for stocks, long bonds, gold, and now the crypto markets. So now what? This past week was a down week for everything except short and intermediate treasuries. So let's take a look at the equity markets and where we're at right now. As you can see over this past week, all of the equity indices fell, all of them. ARK finished dead last, small caps next, and then everybody else was bunched up here, but everything was down. And if we look over the past month, very similar story, not a healthy looking market. And year to date, we had a healthy looking market. It still looks somewhat healthy. It can recover from this, but if this keeps going, it's not going to be good. As I said in at least one of my recent videos, so far August is living up to its reputation as the worst performing month in the year. But we still have a long way to go before September 1st. Thankfully, only a couple of weeks more. Let's take a look at the rest of the markets and what we're seeing now.
So you wanna know my name?
Well, if we look at the current equity bottom dynamics, you can see, I don't know if you remember back here, but in one of my previous videos, I said, geez, this looks like it's trying to form a bottom here. But if it does form a bottom and we get a confirmation, that's not a good thing. Well, guess what? That's kind of where this is headed. This is right back up here at 100%, but you can see now the confidence level is rising. And if this confidence level gets up here sort of in the mid 90 to high 90% range, which would be somewhere up here, that means we're possibly at another bottom, but this is going to have to go lower before we get there. And quite honestly, that's where it looks like it might be going. And not just because it went down this past week.
Truth about the one I love.
If we look at risk versus opportunity using the old metrics, you can see that risk acceleration is absolutely through the roof, up here at 85, and then it pulled back on Friday. But the risk level, this red line, is rising. Now, I don't get concerned too much till this red line gets above 80, but it also lags risk acceleration. The fact that risk acceleration is up this high is really concerning. In fact, we took risk off of our clients' accounts on Friday morning. The contrary part of this is that the opportunity level is rising. So, what do you make of this? I don't know. I honestly don't know. And if we look at the new metrics, you don't get much more information. Although the opportunity level has been dropping over this 2-month period, you can see that risk acceleration really spiked back here, fell off, and is rising again. And then risk, this red line, equity risk, is just staying flatline. Now these are new metrics. They're too new. We don't have a lot of experience with them. So we're going to have to see how this one plays out. If it turns out that this wasn't that big of a deal and the market turns around and goes higher, then I'm going to start believing these new metrics more than the old ones. But the old ones right now are saying danger, so we got out of the way.
Changing all the reasons why. Where do we stand?
And what about equity versus safety? Well, if you've watched my previous videos, you know these move fairly quickly. And while the Qs were up here at number 1, let's put a line in here. Let's put a line in the sand. While the NASDAQ 100 was up here in the number 1 spot, and by the way, it was in this number 1 spot, I should really count it, but it's got to be at least 12 to 15 weeks prior to this. You can see what's happened recently. It fell down here, tried to have somewhat of a comeback, dropped down here, and then dropped down here right near the bottom. This is really not good. And if we look at small caps, to give you some sense of where things are at, they sort of tried to rally here as the Qs were falling off. You can see that here. But then they also started to collapse, and you can see where we are now. So the highest risk equities in this stack are all the way at the bottom. This is extremely unhealthy. This doesn't look good. What if we look at cash? Well, if we take a look at cash, I'm just going to go right from here. You can see that it flatlined, it went up a little bit, went up here, danger, danger, and now look where we are. It's clearly in first place. This is extremely unhealthy for equities. And let's just look at the whole stack. You've got equities all the way at the bottom, the highest risk ones all the way at the bottom. You've got SPY in the Dow Jones Industrial Average down here. So all the equities are stuffed down here at the bottom. Long treasuries are down here at the bottom. So we have an unhealthy treasury market, an unhealthy equity market. And I don't even know why gold is up here. It hasn't been performing well, but it must be performing better than all these other things. So that's a pretty sad story. And how does all of this show up in the buying and selling pressure? Well, if we take a look, you can see that the Dow was trying to have some success here. You can see the buying pressure was above the selling pressure, but that didn't last long and the price collapsed. The selling pressure is going up. S&P 500, selling pressure well above the buying pressure, price declining. The NASDAQ 100, price declining, selling pressure shooting higher. And if we look at ARK Invest, this is an interesting picture because these are the highest risk basket of stocks. And you can see that while the selling pressure was way above the buying pressure here and the price was collapsing, on Friday, the selling pressure really started to collapse. Maybe this is a good sign, and you can see that the buying pressure is moving higher here. If this continues, maybe we're at the bottom? I don't know. We'll see what happens next week. But what's also interesting is if we look at small caps, again, similar price action, declining prices, but they actually went up a little bit on Friday, and you can see that the selling pressure, just like ARK, it was well above the buying pressure, but you can see how it collapsed here at the end and the buying pressure started going up. So fingers crossed, maybe things will get better soon. And if we look at sector rankings, now again, these are the old metrics and they aren't really telling much of a story here. I mean, if you look at last week up here, we had Bitcoin in the number one positions. No surprise, it's been going up until recently, until this last week. And you'll see that when I show you the buying and selling pressure, the price has really kind of been collapsing. We had NASDAQ 100 up here, technology. I mean, this looks extremely healthy. Consumer discretionary, cash way down here, consumer staples down here. This looks great. You fast forward to this week, the picture really hasn't changed a whole lot, which is kind of surprising. I mean, it looks, in fact, consumer discretionary moved up. Now, what I don't like is you can see that cash has moved up here and treasuries have moved up as well. So that's a little bit of a hint that things are starting to get unhealthy. Let's take a look at the new metric. And remember, when I looked at the graph showing risk using the new metric, it really wasn't saying things are all that awful. And you're kind of getting a similar picture here. You can see again, Bitcoin innovation, ARK innovation, semiconductors, consumer discretionary, cash and treasuries way down here. Last week, this looked fabulous. And then if we look at this week, very similar, Bitcoin and technology up here, ARK innovation, consumer discretionary dropped a little bit, and cash and treasuries really didn't move at all. And consumer staples stayed down here. So this isn't really telling us anything. And then if we look at sector rank acceleration using the old metric, remember these move fairly quickly. So last week, you can see we had the Dow way up here. That's not good. Healthcare, safety, not good. Consumer staples up here. Consumer discretionary down here. But cash and treasuries were way down here. But this is really starting to look unhealthy. And then if we fast forward to this week, we've got technology in the NASDAQ 100 up here. Consumer discretionary moved up, and consumer staples moved down. But what I don't like is look at this. Cash and treasuries, shorter duration treasuries, moved all the way from here, all the way up here. This really is scaring me. And if we take a look at the new metric, a very similar picture up here with Bitcoin at the top, consumer discretionary, but you can also see the Dow is up here. This is not good. And cash and treasuries are all kind of down here. Now, if we fast forward to this week, Bitcoin's still in number one. It won't stay there if the price doesn't turn around. What else do we have here? The Dow moved down a little bit, kind of surprising. Consumer staples moved way down here, but look at what happened to consumer discretionary. It just collapsed and went way down here to the bottom. Now cash kind of stayed put, moved down a little bit, and treasuries are sort of staying put. Longer duration treasuries moved up a little bit. This is a really mixed up picture, but it's not saying things are wonderful. And it's not saying things are awful. So it's a really hard read at this point. And if we look at the treasuries and how they've acted over the past week, you can see that, again, unhealthy treasury market here, except for short duration and intermediate treasuries finished up just a little bit, not much. And if we look back over the past month, again, the ones that have performed the best are the short duration treasuries, but they're all down over the past month. And year to date, we are at the bottom here pretty much. And then if we look over the past 5 years, we are really close, if not at the bottom that we saw back here on October 21st, 2022. So these prices could turn out to be the bargain of the century because these are safer investments. And if they recover from here, now they can go down more if interest rates rise. And we'll look at the yield curve and you'll see that's exactly what's been happening. The long end, the rates have been going up, which is causing the yield curve to start to uninvert more. And we'll take a look at that. So these could go down more, but boy, over the long haul, I have to believe these are going to end up being quite the bargain. And while we're talking about that, let's take a look at the yield curve. So here's the yield curve. You can see where it was a year ago when it was not inverted. That's this blue line down here. Sorry, this box keeps popping up, but you can see that long rates, 20-year rates, were higher than 1 and 2 year rates. So this is a healthy, uninverted yield curve. Where were we a month ago? We were very inverted. Here's the 20-year treasuries and 10-year treasuries, and you can see the shorter duration treasuries way above the longer duration treasuries in terms of yield. That makes absolutely no sense. You want the higher risk things to have more return, and that's not what's happening here. Now, if we go to just on this past Friday, you can see that the yield curve has begun to uninvert a little bit. Longer rates are going up. Shorter rates are pretty much staying put, with the 2-year going up just a little bit because of the Fed's saber rattling. We'll take a look at how inverted or not inverted the yield curve has been over time. But before we do that, here's what the market's saying. The market's saying there's an 89% chance that the Fed will keep interest rates flat, meaning they won't raise when they meet on September 20th, 2023. And here's what I was talking about with the yield curve. You can see that I've talked about this a lot. Back here, we were at 1.1% inverted. In other words, 10-year bonds had a 1.1% lower return than 2-year treasuries. And then things tried to recover here and then collapsed again, and now here we are. It's 69 basis points inverted. We have a long way to go to get to uninverted. And what's going to have to happen there is one or two things. Long bonds yields have got to go up, which means their prices will come down. That could happen. And the Fed needs to start lowering rates at the short end, which will cause those rates to come down, and then the yield curve will uninvert. So we just have to wait and see how this plays out. And how does all of this show up in the buying and selling pressure? Well, you can see the only treasuries that have done well at all here are the short duration ones, SHY or 1 to 3 year treasuries. And you can see that their price has moved higher, and you can see that the buying pressure is currently above the selling pressure. If we look at intermediate treasuries, they don't look quite as good. You can see the price has really declined here, and the selling pressure still above the buying pressure. And then if we look at 7 to 10 year treasuries, I call these intermediate to long, you can see the price has declined, selling pressure well above the buying pressure, but you can see that it's starting to collapse here as of Friday. And if we look at 20-year treasuries, terrible price action, big drop in price, selling pressure well above the buying pressure, but again on Friday, that selling pressure started to decline. So maybe this is a good sign. And here's what I was saying about gold earlier. You can see that we had a little bit of a rally here and then it just failed. And this has been really going down. And you can see that in the selling pressure, which started back here and has just been rising. Now, interestingly enough, on Friday, the selling pressure also started to collapse and the buying pressure started to increase. But this is not showing any sign of turning around other than that. And we'll have to see if that continues and follows through. And what happened to Bitcoin? Man, Bitcoin was doing great. You can see when everything was falling, this was going up here. And you can see that the buying pressure was nicely above the selling pressure until here where the price just collapsed. And you can see the selling pressure is going through the roof. So this doesn't look good for Bitcoin, at least in the short term. Hopefully this will turn around soon. As I said a couple of weeks ago, we could be in for a few weeks of non-committal behavior from the stock market until the retail investors and money managers get off their beaches and boats and get back into the office in September. But this is starting to look like it could be more than that. I'll feel a little bit better and be a little more encouraged if we get a bottom forming indicator this coming week. But then we still need evidence in the form of a bottom confirmation that we've actually seen a recent bottom. This could take us into early September before we have a good sense of it. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Loving you, girl. I've been waiting time and time again. I've been searching, but nothing else will do. It's gotta be you. You got that fresh look, long curls. You got my head turning time and again. You got that something I need. You got me thinking it's you I'm missing. I've seen the world, but nothing's better than loving you, girl. I've been waiting time and time again. I've been searching, but nothing else will do. It's gonna be you. Nothing's better than loving you, girl. I've been waiting time and time again. I've been searching, but nothing else will do. It's gotta be you. It's gotta be you.